Welcome to the Business of Money. We're joined by Delphine Govender from Perpetua. We've got Mia Kruger International, David Shapiro, Sassman Securities, and Lindsay Williams from strictlybusinesspodcast.com. Delphine, I'm going to throw it to you off the bat here on NASPAS process. I know you've been keeping a keen eye on the situation. Give us the lowdown.
Well, this week, Bronwyn, was really all about the Chinese regulations and the crackdown that actually happened last weekend in terms of the online tutoring space. And, very unprecedented, massively damaging business models for those businesses. But also one of the components was kind of effectively declaring illegal, foreign ownership of these entities through certain structures. And then that just threw a massive spotlight onto the Chinese tech companies, and obviously particularly the likes of Tencent, Alibaba, and then the whole Chinese index, or tech index, took a massive hit this week. And then we saw that translate directly through to NASPAS and process. I think, one of the most important points is that what came into kind of the high risk purview this week was that the structures in which the Tencent asset is owned is called a VIE, variable interest entity. And that's the only way the Chinese government, it's actually certain industries are controlled in terms of foreign ownership. And this is the mechanism. It's effectively just a mechanism or a structure through which you own the Tencent asset on the Hong Kong listing. And the legality of that structure has never been tested. And as a result, the Chinese government, as it showed last weekend, could effectively just declare a structure illegal, at a stroke of a pen. And that's what happened. And unfortunately, what it's meant is that it's raised the regulatory risk again around the certainty of access to those assets. In fact, NASPAS and process shareholders don't actually have access to the underlying assets in Tencent. They only really have access to the rights of the profits and the dividends, etc. That's how the VIE structure works. So we had that happen in the course of the week. It doesn't, damage Tencent's business. Tencent's underlying business is still very much mainland China. That business model is largely intact. It's really, and the Chinese government needs those tech companies in terms of innovation, but it really started to bring into question the general risks that exist when you invest in VIE structures, particularly Chinese tech.
David, I've just conducted an interview with a chap in Hong Kong for the last 45 minutes. And what came across, he's a Chinese gentleman working for a Western asset manager, but based in Hong Kong. And I asked him to explain what has gone on when it started with Alibaba and their pay platform and the cancellation of the listing, and then going to Didi and now going to the education companies. And what came across in his introduction, lengthy introduction incidentally, is that we are way apart, poles apart when it comes to the way that China looks at business and the way that for example, the United States looks at business. And he explained the ideological philosophy of what has gone on. And he also went to great pains to tell me that behind closed doors, there was a meeting from the State Council of China and investment banks. Although those details are not sketchy, but certainly private, it just came to me that they have one way of doing things and we have another way of doing things, and hopefully there can be some meeting in the middle ground. But have you been scared, David, by what's happened recently?
I'm scared to a point. Look, China's a big economy. We can't ignore it. We can't ignore their purchasing power, and we can't ignore what they add to global growth on an annual basis. They add more than America. Even though America grows, you get more growth from China. Maybe not last year, but still on an ongoing basis. And sooner or later, they will catch up with America. So we can't ignore that. They have a population of 1.3 billion people. The middle class is growing. They're spending. They're part of the purchases of LVMH and Kering and Hermes and all the luxury goods, and not only that, commodities and so on. So we can't ignore it. But I think you have to be very careful how you pay it, and I think you have to moderate the extent to which you're exposed, simply because of the risks. You want to know that your rights are protected by law. You don't want to forfeit those rights, because as Delphine said, at the stroke of a pen, they can negate anything that you hold. And to me, that's the big risk. So I'm saying, by all means, go into China, but just moderate your risk. Keep it at a level that you're comfortable with. And I think Lindsay, I think that's what we're seeing now. You're going to see a lot more fund managers over this weekend downgrading their exposure from overweight to neutral. And that's where there's going to start seeing a little more selling on some of those companies.
Mia, how are you viewing the situation? And will you be one of those fund managers downgrading your weighting?
Well, I think the importance, as David and Delphine both explained beautifully, is the fact that the whole idea of shareholding up until now, that people thought they were a shareholder of shares in Tencent, etc., is actually all governed by contract. So you don't really have many rights on that, and it's like, you know, it puts you in a very difficult position. So we've seen how the markets realize it. I actually don't understand how the market only realized it now, as all this information has been out in the open. You could have read all the contracts, how it works, but it seems like people prefer to just go with the herd. So, and in the case, as I explained in a previous conversation as well, is that the fact that both Naspers and Prosus still remain such a large part of our local bourse, it actually has pulled back quite a bit now, but it still is the dominant two shares in the top 40, and that makes it very, very difficult for any fund manager in South Africa who's benchmarked against the index to really sell a lot of it, because if there's a bounce or a recovery, they'll be far behind. So it makes it very difficult. Also, from all the tracker funds that's invested in these structures and in these shares, it's the same story. They won't sell it because they follow the benchmark. So there are various things to consider here. We, as I've mentioned to you in the past, have a very broad diversification, but still we do have a large exposure to Naspers and Prosus. Like most South Africans, there's really no South African with any investment that have no. Okay, there might be, but it's very uncommon for an investor in South Africa to have no exposure.
I've got to ask Piet Viljoen. I must ask Piet if he's got exposure.
But if Piet has any form of pension fund that he's still exposed to in any way, he'd probably still have some exposure to it, unfortunately. I know he wouldn't want it. But yeah, that's the reality of the fact, unfortunately. So we'll have to see how this plays out. An interesting other view that I maybe just comment on before handing over to Lindsay is the fact that I read a very interesting remark from some fund managers based in China, and their view, being Chinese, is very different to the Western view on all these regulations being imposed. So the Western media, which is everything we all read mostly, is much more critical in terms of how the government acts, what the government does. But most people within China are part of the middle class, which David alluded to has grown and has been strengthened in terms of financial well-being over the past couple of years. And they are very happy with what the government does. Most of them are supporters of the Chinese Communist Party, and in the Chinese Communist Party doing many things that benefit the majority of people in China. Obviously, they have their own agenda as well. But it's quite interesting for me to read those commentaries coming directly out of China instead of from Western media. And then just the last thing is that Delphine referred to, you don't really only have exposure to China. You don't have to take exposure to China only through VIE structures. You can actually go in various other companies that's not controlled by VIE structures and get exposure in that way. And I think that's sort of where most people will be starting to look now. Tech was obviously in the front and easy to follow for everyone. It's talked about everywhere. You can find a lot of information on it. The rest, not that easy.
Wouldn't it be fantastic if South Africa could actually be as serious about educating young people as China is? I mean, it's the first foundation of the future development of a country, to have people that are educated, but that's another story. While we're on tech, let's stay with tech and go to big tech in the United States of America, because these numbers have been unbelievable, Delphine. Last night, okay, Amazon, I think they grew their earnings by 26%. Compared to last year, and they warned that this growth can't continue because apparently people like David Shapiro are going out and buying stuff from shops because he likes to mix with people and annoy them. But more seriously, there is now going to be a sort of withdrawal of people shopping online because they want to go out and mingle. But when you see these numbers, Delphine, what is your attitude? Do you say, well, it's all already baked into the price, and there might be a little bit of a sell-off, but I'm a lurking buyer. What's your approach to this?
Look, I think there's really two points to that answer. The first is the market reacted because the very bullish narrative that's been really belying kind of the short-term sentiment and the share price. Just completely common sense, as even if we had to have a conversation perhaps with Takealot in South Africa, who's had kind of stupendous growth rates because of lockdown, etc., and just the volumes through e-commerce. The narrative, as one would expect, common sense from Amazon is we can't maintain these rates of growth, because people are obviously doing offline shopping as well. So that's the narrative that affects the short-term kind of sentiment into the share price. I mean, the longer term, the real question about, do you use these opportunities to invest for the long term? And I think perhaps the best investors in businesses like Amazon are the ones that just never sold their shares, because they've just actually just compounded and compounded and compounded. And so you really have to and there's going to be a cohort of shares, I guess, and businesses in your portfolio that perhaps, as Buffett says, if you lock up the stock market, or shut down the stock market for 10 years and you come back in a decade, they're going to be bigger businesses. And I think Amazon's one of those businesses that has sat and will continue to sit squarely in that category. It has a moat. It has a wide moat, and it has an enduring and a moat, importantly, that it can expand because of its ability to aggregate. Quite a few of the other companies we're seeing are having struggles to maintain their moats. They're being disrupted. I think at the margin, there will always be, and it's interesting because big tech's actually cannibalizing each other. Once you've taken out kind of the mainstream status quo offline traditional competition, then you start eating each other's lunch. So the most likely competition, for an Amazon is likely to come, from whether it's Google or, Alphabet, etc., or Facebook or Instagram, etc. So you tend to find that will be where their challenge lies. I personally don't own Amazon. Obviously, it's a big regret. It's one of those errors of omission. But at the same time, I would be surprised if the business didn't compound just at the rate of growth. It simply cannot maintain its rate of growth. None of big tech will be able to, just because of their share, the vast. I mean, I think those top five companies account for 25% or 23% of the profits of the whole S&P, which means there's 495 shares that account for the rest. So you tend to find that just probabilistically there's better value on a short-term basis in some of those stocks outside of big tech, but they have a massive moat.
Let's build on this conversation and bearing in mind, Mia and David, our other audiences are not the same audiences as today, so don't feel as though you are repeating yourselves. I want to build to the tech portfolio, David, that you are currently alluding to, and those are the A's in the alphabet. So let's go there.
You asked us what's my favorite stock, and I said, okay, well, let's start with A's. Let's start with Adobe, and then we go on to Amazon, and then we go on to Alphabet, and we go on to ASML, which is still my best company, which is the Eindhoven business that makes the machines that make the chips. And the other one is a payment company in Holland as well, called ADYEN. But which is a wonderful platform that's growing in the payment segment. So I'm saying that's on the A's. I said next week we'll do the B's. Just to take Delphine's point further, no matter how big that moat is, you've got to maintain it. And this is where the answer lies. When you look at businesses, and I've mentioned this point before, look at the R&D. Look what they hold back to reinvest, and look where they're going. When Zuckerberg was attacked the other day on Facebook about slowing down advertising because of the same problem that Amazon is facing, he highlighted where else they're going, where they're looking for. The cannibalization is taking place because he wants to go into e-commerce as well. But look at those businesses. They've got the might and power to continue growing into new segments as well. So don't dismiss them because they happen to miss on guidance, or they're lowering their guidance for the reasons that we've discussed. So I still think that you've got to have a fair choice of tech in a portfolio.
I'm going to stick with the A theme, please, David, and I'll put this to Mia now. I've got two A's. And it's not the Automobile Association or Alcoholics Anonymous. It's Anglo-American PLC, blockbuster numbers coming out of a company that is not all within the bounds of South Africa's borders, but certainly still very much associated with South Africa. And they really came out with spectacular numbers, and they're behaving responsibly, they're paying dividends, and they're making hay while the sun shines, Mia.
Yes, no, I mean, and they are big supporters of our president. So that was very interesting also this week, coming out supporting South Africa, saying that they will be investing money in South Africa and that they want to be part of a turnaround in the country after what we saw 2 weeks ago. So that I found positive as well. They did really do what David always say he hopes mining companies will do, and that's pay out a lot of the money that they made. It was about a third of the money that they made in profits that they are paying out in dividends, a special dividend, a normal dividend, and they're buying back some shares. So they're really doing good to the shareholders, not only investing a lot of money into mines in South Africa, but I think if you consider the underlying trend, the fact that we all know this is cyclical, we know that the government in South Africa has used this profit that they haven't bargained on as a windfall to pay a 350 Rand grant now to people. Unfortunately, the reality is how this helps South Africa now is not going to be there to help us through all times in the future. We know that commodity prices are cyclical. So, but that's a whole other conversation on the economical side in South Africa. To get back to the commodity companies and mining companies in South Africa, I found it also particularly interesting how De Beers came out and they mentioned that they had very strong demand from the US and from China, and that just plays into the theme that we've also discussed alongside tech now for a while of luxury goods and how people are spending a lot of money on luxury goods, and how when Richemont came out with the first numbers, they just showed us that, and De Beers now being part of that stable showed us that the trend is real, and that there's a very strong recovery in luxury good companies as well. So mining, luxury goods, I'm sure they really play into each other's hands, but interesting to see how they go together really so fast.
I'm mindful of the time. We need to move to stocks of interest. I'm going to open up here with Delphine. Lindsay, you can pick up as we drive stocks of interest around the table.
Thank you. Delphine, over to you.
Yeah, so I think what's been interesting in this last 2 weeks is obviously following, the riots and the violent riots in Durban, particularly KZN, a lot of monitoring, resets on some of those cyclical companies that would have been affected, particularly obviously the property companies. We saw them kind of take a smack in the middle of the month. Some of the retailers that were particularly exposed, so the likes of Massmart, some of the other food retailers, etc. And then obviously just general consumer facing companies. And then obviously this week we also saw Tiger Brands, unfortunately, with some issues with faulty packaging and a massive recall on their Kruger product. So for me, I think what's been of interest are particularly some of the retailers and some of the banks. It's largely driven by, again, you have to separate the fact that it's fantastic that we need to see more companies like Anglo that Mia referred to coming through to really support the structural changes we need to see in this economy, particularly that we saw surfaced, and perhaps the scariest reality in South Africa is our inequality. So we have the wealthiest 3,500 people in South Africa. That's only 3,500 people that command wealth that is more than 32 million people. Now, there's nowhere else in the world that sort of extreme reality exists. And so as we look through, we talk about investing in retailers and consumer stocks and banks, but if we don't have the majority of the population economically active, able, in gainful employment, particularly the youth, what is the long-term true prognosis for the business cases of retailers or consumer companies, etc.? We can talk with much more optimism about Amazon, etc., because we can see kind of long-term, structural trends. The hard part in South Africa is how can I sit here today with a high level of optimism, telling you put your money in South African retailers for 10 years when they're majority, predominantly domestically oriented to a domestic consumer. And so to take that long-term view, you really do need to have a high level of belief and conviction that we're going to see execution on the actions and the policies that belie economic, reconstruction and recovery. On the short-term view, however, we're investors. And one thing we've discovered is that actually, or we know through kind of reality, is that GDP growth and stock market performance is actually not as causally connected as one would believe. In fact, it's corporate earnings growth. And so what we're seeing for the next year or two is that in that cohort of companies, the retailers, so Massmart and Truworths, largely because of this reason, not because I think there's a 10-year story, but because I think there's an earnings recovery story coming that the market's not pricing.
Jolly good. Mia, you've chosen, as far as I can remember, in the past, Nike and Starbucks, aspirational brands to certain people. What have you got this week?
And Apple. You can't leave Apple out of the equation. She also chose Apple.
David's the Apple man. He's going to the big Apple, so he's the Apple buyer. So let's stick with the two I just mentioned. But what have you got a real company this week?
Thought I would be able to stick with the A theme and say talk a lot about Apple again, but you all know how much I like the company and how strong the company is. So I can leave that for over a couple of months. We can revisit that. But with the A theme, it's not only Amazon, and where we saw Amazon come out last night, slightly disappointed on the revenue side. I'm going to talk about Amazon and about Microsoft. They really showed us that cloud computing worldwide is booming. We saw the Amazon Web Services grow by 37% over the last quarter, much stronger than what we see for the rest of the business. Their whole other business, which is only a small part really of their business, grew by 87%. That's their services, advertising, and web services, which is the cloud computing. And then when we look at Microsoft Azure, we saw the same story. Microsoft Azure is also one of the strongest players in the market, and they grew their web services by 30% over the last quarter. So those two areas, part of that moat that Delphine and David alluded to, that is still the growing parts of the moat. And those are the sorts of things that we need to pay attention to and look at. And that's also for advertising is where Google came in, and they made a lot of money on advertising because people spend more time on YouTube, more time online, and people like to be, these companies benefit a lot from these advertising campaigns that they run, and that's what really the business model of Google and YouTube. So I think I've covered a couple there.
David, I hope that Mia hasn't stolen your thunder there, and you've got something different. Away you go.
No, I'm going to go from one extreme to the other. My heart lies in tech and growth companies, but I make a habit of trying to go through every set of results that comes through on the JSE, and of course overseas. And this week you've got to look at the junior miners. I mean, we have to look at how these companies have swung around from wildly negative to grossly positive. Not the Anglos or Kumbas and that, but if you look at a company like Merafe, which we have just basically dismissed. I mean, it's a non-existent company that really is nothing more than owns a joint venture in a ferrochrome business with Glencore. And I mean, their earnings are staggering, and the amount of cash on their balance sheet makes up about 30 or 40% of their share price. And I looked at ArcelorMittal as well, and it's the share price has gone up dramatically. I've got to spend a lot more time going through steel production, but I saw 223 earnings, and for a share price, and that was half year, that's trading at 6 or 7 rand. Now I might have got the decimal point wrong. I am an accountant, but sometimes I do put the decimal point in the wrong place, and I might have got it completely wrong.
No wonder some of these companies had so many problems when you were auditing them in the past, David, but never mind.
Sorry?
I said, no wonder so many companies had problems when you were auditing them. Because you put the point in the wrong place. You've been inflating them. The opposite. Anyway, sorry.
No, but the point being is that I think we've underestimated what the impact's going to be on the mining segment. So a lot of these companies are not, a lot of mining companies are not listed in that. So I'm with Delphine and Mia, and I must thank them for participating next week in something that Leila Faria is organizing, or I got her to organize, which is a seminar just to share our views with people, with younger investors, etc. And the theme that I'm focusing on is around mining and the companies that are going to benefit from it. And I think this is something that can be very useful for young investors or people who like to who like to manage their own portfolios.
So your particular stock of interest for this show?
Well, I don't want to say, I'll say Merafe, but I think it's more a segment, the junior miners that I'm going to focus on. There's a mine called Alphamin. And when the chap came to promote this tin mine somewhere in the DRC, we all were very cynical. But I mean, you must have a look at the profits they're making. And I thought that tin was used to make coup cans, for Tiger brands, but it isn't. It's used for soldering in the electronics industry. And I mean, it's just going through the roof. So just for fun, have a look at some of these companies. Yeah.
It's an unusual U-turn for David Shapiro, Bronwyn, because normally he ignores commodity companies because he doesn't understand or claims not to understand, let me qualify that, the cyclicality of commodities, and it's out of his control. But he's suddenly coming around to this, and I think that's very interesting. The smaller companies that are not covered by the big asset managers, but maybe should be looked at by retail investors. Bronwyn, can you wrap up the show this week?
Sure. Although I'm not going to come with the quirky outros. Lindsay Williams, strictlybusinesspodcast.com, David Shapiro, Sassman Securities, Mia Kruger, Kruger International, and Delphine Govender from Perpetua. Thank you very much for joining us on The Business of Money.